Hey everyone, thanks for watching this video. Today we're going to be talking about conventional and adjustable rate mortgages. So I know this is a topic that obviously you're super excited about, but we're going to talk through the differences between the two, and there are some differences that have an impact ultimately on what you pay over a period of time. So first off, we're going to be purchasing a home. That's the first kind of step to this process. And so as you can see here, I have a wonderful home that I'm interested in purchasing. It's got nice green grass. Color scheme's a little odd, but it's in my budget, so we're going to go with that. We're going to purchase this home, but we have a couple of options, right? We have what we call a conventional mortgage, which is one that probably 90% of homeowners actually have a conventional mortgage. But then we also have the option to do what we call an adjustable rate mortgage. This is often referred to simply as an ARM, so ARM being the acronym. And so we want to figure out which one of these is right for us. And so we're going to go over the differences between the two to see which one better fits our needs. So starting with a conventional mortgage, I mentioned that 90% of borrowers opt for a fixed rate loan or a conventional mortgage. And the reason is because your interest is fixed for the life of the loan. So you don't have to worry about your payments adjusting. So what happens, let's say we have a $200,000 mortgage that we are paying at a 4.2% interest rate for 30 years. All of this is going to result in a payment of $978.03. Now this is only principal and interest. So if we, obviously property taxes and homeowners insurance, that would have to be paid separately. Many mortgage companies or lenders require you to have what's called an impound account, which means we're going to take this amount and we're also going to add in what we would expect to pay or project to pay for property taxes, and then also homeowners insurance, which I'll abbreviate simply as HI. Some lenders, you can keep it separate and you pay it on your own. It's really up to you. I know some people that really like an impound account because it's kind of a forced savings, and so you don't have to think about that property tax bill and you don't get that unexpected property tax bill. And I know some people who would much rather save the money and get the interest on their own and then withdraw it and pay for property taxes. Typically, most lenders, if you put in less than a certain amount, so less than like a 20% down payment, you will generally have to get an impound account. Obviously, it varies based upon the lender. But let's just say that we don't have to worry about this impound account, and we're just worried about the initial payment, which is the $978.03. This is going to remain the same regardless of how many periods we go. So whether it's the first month or the 360th month, since we're doing a 30-year mortgage, we will always pay $978.03. Now, the amount that goes towards interest and goes towards principal, as you know, varies. If you're kind of confused by that, check out a previous video where we cover amortization and how that affects your principal and your interest and where your mortgage is going. So this is really good because there's a certain amount of familiarity to it, right? Because it's fixed, a conventional mortgage is very predictable. So if you budget every month, you can expect to budget $978.03 under your line item for your mortgage, and that's always going to be the same. You don't have to worry about it changing, and people love the familiarity. And that's one of the reasons why 90% of homeowners opt for the conventional mortgage. But we also have this other option here, and that's the adjustable rate mortgage. And so with adjustable rate mortgages, what happens, simply like the name implies, the interest fluctuates. So with adjustable rate mortgages, typically they introduce what we call a teaser rate. And so that teaser rate, think of it like if you're in the US and for internet, you can have Comcast or Xfinity or whatever they're calling themselves now. And they tell you, hey, you can get internet and cable for like $50 a month, right? And it's a 12-month period. And for that 12 months, you pay $50. But then at the end of your rate, at the end of the 12 months, it's going to go up to $120. And so that's a teaser rate, right? You get locked in with the low rate. That's what attracts you to the service. And then the price goes up. And in Comcast or Xfinity's case, the hope is that people would continue to pay the higher rate and wouldn't call in to renegotiate or switch to another carrier. It's a basic pricing model. So adjustable rate mortgages use a very similar pricing model, only they're doing it with interest rates. So currently, a 30-year home mortgage might go for around 4.5%, give or take, and depending upon your credit score. So the same rate with an adjustable rate mortgage might start at 4%. And so initially you might think, man, this looks really attractive. So I can get a 4% for my mortgage, which in turn affects my mortgage payment, which is great. But over a period of time, what happens is this rate might fluctuate. And so the next year, we might go up to 4.2%. Not really a big deal. Technically, we're still saving money from the 4.5%. We're 0.3 of a percentage point lower, which is fantastic. But it can also go up 1 or 2 percentage points. And so we might end up paying, let's say, 6% on our mortgage. Now, this isn't really an issue until people make decisions on what they're going to pay for their mortgage based on this teaser rate. So if I stretch my budget and I get an adjustable rate mortgage and I can barely afford the teaser rate, well, when the rate adjusts to 4.2 or potentially 6%, that's when it can have a really significant impact on my budget and really stress my finances. And that is what happened about 10 years ago, or a little over 10 years ago. A lot of families opted for the adjustable rate mortgage because rates were historically low. Homes were always going up in value. And so I got in with the teaser rate, but then as interest rates began to creep up, families couldn't afford the adjusted rate, which is problematic. Now you're probably thinking, in what circumstances would an adjustable rate mortgage make sense? Well, a couple of things that are important. Our adjustable rate mortgages typically have a cap. And so there is a cap of how much the rate can increase over a certain period of time. So it's important to understand what that cap is. It's set by the lender. And so you want to know, worst case scenario, what's my cap? I would personally, if I were doing an adjustable rate mortgage, which I don't, but if I were, I would adjust my finances to the point to where I can cover this cap. So I'm budgeting like my mortgage is at whatever percentage the cap is. Now I know some people really enjoy adjustable rate mortgages, particularly if they don't plan on being in the home very long. And so they're maybe planning on being in the home for a couple years. And so there's not a huge opportunity for the mortgage rate to increase. But if you are going to be in the home for a period of time, typically the conventional route is what most families will go to just because of the predictability of that sort of thing. The other thing is, it's really hard to predict interest rates. If you could predict interest rates, you could make a lot of money in a lot of different types of securities. So trying to figure out what interest rates are going to do or what the Fed is going to do is really hard and would require a lot of time committed to be able to try to analyze those trends. And so for that reason, many people opt for the conventional mortgage over the adjustable rate mortgage. But that's a little bit about how those two forms of funding work.